there's a lot of these growth names that they're down 80-90%. So I definitely think there's assets out there right now that could easily double or triple or quadruple if you buy them now and you hold on to them for, a few short years. What's going on, traders? Andrew O'Connell here with Pristine Capital. Welcome to our weekend market analysis video for May 14th of 2022. I do want to say last week was a dogfight. It was a very tough week for investors, and I saw so much capitulation. I saw I was getting phone calls from family members, people that are not involved in the market, that they were just throwing in the towel and basically saying oh my gosh, it's been so tough, my 401k, my long-term investing, that sort of thing. And I think a lot of professional investors were also getting flustered by the market. So I gotta say, for everyone in the Pristine Capital trading community, everyone handled this like a true professional. So I gotta say, hats off to everyone that kept their composure, and we ended off the week on a very nice note. Now, I would also like to say, as we dive into this analysis, I'm seeing some major changes that are occurring in the market, and that could lead to a multi-week rally. So let's dive in here and let's assess this market action. As you can see, last week's price action overall was still some big net losses. We had the S&P 500 down 2.34% on the week, NASDAQ down 2.36%, Dow Jones down the least, only down 2.08%. Now Russell 2000 was down 2.47%. Now keep in mind, this has been a slugfest of a year so far. Year to date, all of these indices are down by at the very least double digits. And look at this, for our stocks above the 50-day simple moving average, take a look at what a washout it's been in all of these indices. Pretty much every single one is approaching capitulation levels of stocks above the 50-day simple moving average. So we'll start off with the S&P 500. We only have 21.38% of stocks above that 50-day. Take a look, we are approaching this capitulation zone, which is where we entered before every single major turn in the market. Now let's also look at the NASDAQ. You can see the NASDAQ has been in the capitulation zone. We only have 13.72% of stocks above that 50-day simple moving average. Russell 2000, only 14.29% of stocks already in that capitulation bucket. And then we have the Dow Jones actually doing the best with 30% of stocks above the 50-day simple moving average. So to say that last week was a capitulation event, that would really be an understatement. Speaking of capitulation, let's look at our weekly performance data. Tesla was down 11.1% on the week. Nvidia was down 5.19%. Apple down huge. Microsoft down huge. So this really was the week where the assets everyone was hiding out in, these all got blasted. And when Apple and Microsoft are declining like this, that's when you know you're going to see that weakness show up in the S&P 500 as well as the NASDAQ. And remember, these stocks and these indices, they did not even close on their lows. We actually hit our bottom on Thursday. Now here's where things could really change. So we just established things look really capitulatory, markets are weak, the trends are weak, but we did get our inflation data. We got the CPI data, we also got the PPI. And here's the kicker that not many are going to realize. So we have the Federal Reserve tightening monetary policy, right? We're getting the interest rate hikes, and we are getting the balance sheet roll-off, which is going to start in June. Now, this is the key. The market started selling off, especially growth stocks and crypto, well before the Federal Reserve announced their monetary tightening. Smart money investors were able to sniff that out, and they got out in front of this huge pickup in inflation. But now look at what we got last week. This doesn't seem very significant, but we have our first sign of an inflation deceleration. Now, I know a lot of you are going to look at this and say, yeah, but 8.3%, that's still a really bad number. And of course it is, but the smart money, they're not looking at what is happening right now. They're looking at what could happen in 12 to 18 months. So could investors begin to sniff out the peak of inflation, and could they start to allocate themselves a little bit differently moving forward? Also keep in mind, when you have these capitulatory blowouts like that, And when you have everyone dumping growth stocks left and right, like, oh my gosh, I got to get out of these things, like stocks going down 30 and 50% on earnings, you know that everyone is tilted to one side. So even if, let's say, like I've used this analogy a few times, we don't have hard evidence that inflation has peaked yet. Let's say, investment managers prior to last week, they had a 0% probability baked in that inflation had peaked. Maybe now after this week's data, look at this PPI. Maybe that goes from a 0% probability to a 20% probability. When you have everyone on the same side like this, that can really be market moving. PPI only came in at a 0.5% increase as of this last week's data point. So yeah, I think that is something that a lot of investors are not going to realize. And if the market continues to rally next week, I think there will be a lot of investors that say like, oh my gosh, I'm shorting into this. This is too much. The inflation's still bad. But this is definitely something that I want to keep monitoring throughout the months to come. And look at this. So not only am I saying this, but if we look at our 10-year inflation break-evens, which we do every single week, these actually went from a 2.86% reading to a 2.69% reading. These inflation break-evens, this is the bond market pricing in their future expectations for inflation. It's not a backward look like we get in our data points that come out every month. So the bond market, the signal that I'm getting by looking at this chart is the bond market as well. They took a look at these inflation data points and they adjusted their future inflation expectations down just a bit. S&P 500. Now let's look at our indices and where we are. On the long-term chart, this is our weekly chart right here, and this is our yearly value area. We actually dipped below this yearly value area low of 40.55.25, but we ended up putting in a hammer candle. So look at the rough ride that the markets have been in for the past, 4 or 5 months. This entire year-to-date period, we finally hit our destination, which is this bottom of value, and we actually undercut it as well. So I'm sure there were a lot of players out there in the market that their sights were set on that yearly value area low, and they likely stopped out of positions as we undercut it. That's going to be a key level to watch for in the upcoming week, this 40.55.25. If we reclaim that level and get ourselves back in value, that also could catalyze more of like a squeeze type rally. And some players that are saying like, oh my gosh, I exited the market right at the bottom. Geez, now I need to chase it and get back in. Now, in terms of this potential rally and a potential trend change that we're noticing from that inflation data, it could look somewhat similar to what we had in late March, where you get a pretty violent couple weeks of upside. Now, I think where a lot of retail investors will get wrong-footed by this is just because we might get a relief rally, that doesn't mean we're going to go back to that 2020 market where you can, like, look at what we had here in 2020. You could just be buying stocks every single day and just continue to mint money. I think for this kind of market environment, you can get some entries if they're really early in the sequence, if you can be quick. But I think if you wait around and you say like, oh my gosh, like I don't believe this, and then you end up, buying weeks and weeks into the rally, your chances of being successful, I think, are still pretty low. This is our intermediate term trend. It's our daily chart. And this right here is our monthly value area. We are still below our monthly value area, and we're below this teal downward trend line. My trend model, however, flipped from a -3 all the way to a +1 as of Friday. So my trend model is positive. I want to make sure that I am not net short the market, and I have a detailed playbook for how I operate when my trend model is at a +1. And I have it in a slide at the end of the deck. We will touch on that later in the presentation. But yeah, another level to watch for. So we talked about that 40.55 level for the S&P 500, right? Another level is really just this downward trend line. What does the market do when we hit that? And then beyond that, we have this 20-day simple moving average, which we are still pretty oversold from. Remember, in the most bullish trending market, you always have those periodic pullbacks to the 20-day simple moving average. Same thing in the most bearish of markets, you have those periodic pullbacks to the 20-day SMA. Here's our hourly chart, and you can see here we're going to have a brand new weekly value area come Monday, and we're going to be trading right inside of it. We're actually going to be pretty close to the top of value, which is at 40.50. Here's our NASDAQ. Very similar picture. We're trading below this yearly value area, and we put in a hammer candle as of last week. Russell 2000, similar deal, hammer candle, and we actually pulled back to this 200-week simple moving average. And if you look, we actually gave back all of our post-COVID gains. So yeah, Russell 2000, this one's definitely pretty washed out as well. And you'll also notice that for all of these indices, there was a big pickup in volume over the past couple weeks. Dow Jones, this one has been the best performer out of all the indices. It's a little bit more defensive, has more of like the old economy names. And this one as well, you can see we put in a hammer candle. All right, let's jump over to our volatility and the VIX. This is another pretty big signal. The VIX was stubbornly bid above a 30 handle for the past few weeks. And now as of Friday, we just had a vol crush and we're now trading at 28.86 for the VIX. Now again, in this kind of market environment where the Fed is tapering, I think if you can allocate into some equities pretty early on in the rally, you're okay. But rest assured, most investors, they'll wait until this thing gets back to a 22 and then they'll start FOMOing in. So as these trends change, it's super important to, be as quick and nimble as you can if you are an active trader. And here's our VIX futures term structure. We can see as well that after that inflation data came out, the VIX futures term structure is no longer backwardated. So we have this upward slope on these first few months. So it really just shows like there's no longer this panic bid for protection. Here's our Bitcoin weekly chart. Bitcoin, this is the apex risk asset. And look at what we've got here. We had this box that we were trading in for the first few months of the year, and we actually broke that on volume. And we had the whole like Terra UST debacle. A lot of those investors lost their money, and really just the whole crypto market has been under distress. Now what I noticed here is we're finally below 30K, which if you're a long-term Bitcoin investor, like this is another dynamic that I'm noticing in terms of how capitulated this market is. There's investors that were so excited at like 64K, and now at 29, they're like, oh man, I don't want to buy this. Or like, I don't want to buy growth stocks down 80% or whatever. So that's really just another signal. But okay, I digress. Let's look at Bitcoin. You can see we had these lows that we made last year. And every time we've hit around this 29 to 30K level, there's this invisible hand that just steps in and buys Bitcoin. Now we actually undercut those lows from last year. And now as of today, we actually reclaimed those lows. So we do have this undercut and reversal setup. And look at this as well. Look at this huge capitulatory low in March. Look at the volume for Bitcoin. Now look at this next capitulatory low in May. Huge volume as well. And granted, we kept bleeding a little bit for a couple weeks, really just we consolidated, but that was a major low. Now look here on this past week, another major week of volume. So yeah, I actually added some Bitcoin just a few hours ago. So I bought some spot Bitcoin in my crypto account for about 29.6K. And my game plan is to add to the position if and when Bitcoin reaches 20K. Because yeah, at this point with a lot of things that have occurred in the market, I feel more comfortable buying things where it's like, hey, if I have a somewhat longer time horizon, like, hey, I feel pretty comfortable buying Bitcoin at 29K, buying it at 20K. That for me is perfectly fine. Here's our Squeezemetrics dark index measured against our dealer gamma. And you can see as of this Friday, we are right in our dark blue opportunity zone where the forward 1 month SPX returns are pretty elevated up here around 3% to 3.75%. Now I think that's why it's pretty important to make sure that you're quick, because the dealer gamma is still negative, and that's where you can get those huge swings. If you wait for like the next 5% upside in the market, your risk reward is just not nearly as good. Here's our total put to call ratio. Speaking of how fearful this was, look how elevated these total put to call ratio readings were. We had readings up at 1.25, 1.3, and multiple all within the same month. Now, at the very end of last week, it does look like there was a bit of a sea change, where 0.99, in the grand scheme, it's still a pretty elevated reading. It's not like it's complacent by any means, but it does look like some players said oh, okay, the worst might be behind us, and some more call buying occurred at the end of the week. CNN Fear and Greed Index, This hit a capitulatory 6 reading last week. Of course, when it's at 6, no one wants to buy. We're still at 12. So this is an extreme fear reading. Pretty crazy stuff. AAll Investor Sentiment Survey came in at 24.3% bulls, 49% bears. So not quite the extreme terror of a few weeks ago, but by all means, retail investors, they are still bearish on a net basis. And this is the indicator that really just puts the icing on the cake. Our NAAIM exposure index, every week these active investment managers, they're active equity managers, they're asked, how much exposure do you have to the markets? And look at this, this came in at 24.31. So basically, let's be perfectly honest, all these active equity managers, they got blown out of their positions. It's wild. The market era actually posted another indicator as well, but we just experienced the largest 5-day degrossing of hedge funds that we've had, I believe it was since like 2015 or 2016. So as I look at this picture, I'm like, come on now, like the hedge funds got blown out, these active equity managers got blown out, retail scared, everyone's scared, and we finally got a potential catalyst that, hey, things might be changing on an incremental basis. And here's our seasonality data. You can see May is a rough month of seasonality, and so far that's really lived up to all the hype. As we end May, there is the potential, seasonality wise, for a bounce in the market. Here's our US Treasury yields as we move over to our fixed income data, and we can see that our 10-year Treasury yield went over 3%, but by the end of the week, we did have a rally in treasuries. Our 10-year Treasury yield is now at about 2.92%. So that's a good thing that we're finally getting some sort of a snapback, because look at how parabolic these 10-year Treasury yields went. I think all we really need is some sideways consolidation in these 10-year Treasury yields, and I think that'll be, on a net basis, a good thing for the market. Like, this is the most difficult scenario for the market, where we're just ripping higher in parabolic fashion. And then we did get a blowout in our high yield credit spread. These went from 8.81% to 10.13%. So you can see there's been for sure a panic over the past couple weeks, and this really just illustrates that. Now moving over to our Fed speak. Now we know that the Fed, they ended their asset purchase program in March, and now the Fed is preparing to begin QT, which they said it's going to start in June. But take a look at this. We've had this snippet over here for a couple weeks now, probably even a couple months. The outcome is going to depend on whether inflation eases. That's really what the Federal Reserve is looking for in order to get any more dovish. And after we got those inflation prints last week, I believe it was on like Tuesday and Wednesday, we got new commentary. So look at this. This is from Neil Kashkari. The Federal Reserve will do what it needs to do to bring down very high inflation, though how much it will need to do depends in part on how quickly energy and other supply constraints dissipate. So this is the catch-22 that the Fed is facing. Inflation is pretty high, right? And the only tools that they have to reduce inflation are raising interest rates and their open market purchases, either doing QE or QT. Problem is, this inflation has nothing to do with interest rates. The Fed altering interest rates, that's not going to solve the Ukraine-Russia war. It's not going to end, the US tariffs that are on China. It is not going to end China's zero tolerance COVID policy where they keep shutting down. It is important to note that the Federal Reserve, at least they are cognizant of this, that some of it's out of their control. And if we start to see these lighter inflation prints, maybe we get that little bit of dovishness on a net basis. And then we also have daily here. Going up in 50 basis point increments to me makes quite a bit of sense. And she said, she added that a 75 basis point increase, which has been the subject of speculation as an option to curb surging inflation, is not a primary consideration. So they are saying, hey, we want to do 50, we don't want to do 75. The bond market's getting a little bit crazy and a little bit overzealous if they're starting to price in 75 basis points. So that is a good thing. Now, of course, as we look at our Fed balance sheet versus the S&P 500, the S&P 500, it's really moved out in front of the balance sheet. The balance sheet over time, it's going to start getting a little bit smaller here. And we can see that our S&P 500 already had like that panic event. Here's our rate hike probabilities. As of right now, the market is implying about an 82.9% chance that we do get that 75 basis point rate hike and only a 17.1% chance that we get that 50 basis point rate hike. But we're seeing the Fed is saying, hey, we want to do 50. So this is another key to watch. If the market starts shifting from pricing in 75 to pricing in 50 basis points, then that on a net basis is actually monetary easing. And then let's look at our key economic data for next week. We have retail sales coming out on Tuesday. We also have Jerome Powell that's going to be speaking on Tuesday. We do have a few Fed speakers. And then we have some housing data coming out later in the week. We have our housing starts, building permits, and existing home sales. Mortgage rates have more than doubled over the past couple of months, so definitely going to be interesting to see those. So here's our key insights. So number one, my trend model flipped from -3 all the way to +1. So I want to make sure that I am acting accordingly. So I want to make sure that I'm net long. I'm not, shorting the market, trying to fade the market, anything like that. Our dark pool signals in positive territory, and we just experienced a massive liquidation event. So my strategy, as always, this first bullet, I'm just going to keep this on here till the end of time. I want to make sure that I'm trading like a professional and not a gambler or punter. So the purpose of our trading group, it's not like, the pristine punting group or like the pristine gambling group. It's trading. And there's a huge difference. My goal is to compound my capital over time. I'm not making any all-in bets or I'm not focusing on like lotto trading and whatever. Like the lotto trading, lottos are for losers. That's really just fact of the matter. Like, think about this. Do you think Warren Buffett is out there like trading lottos? I want to make sure that I'm scanning for future leadership stocks, and that's going to dovetail into our next video for this weekend, which is our weekend watch list. I already have a few things in my mind that are looking pretty good, but I definitely have to work out those trade ideas a little bit more. And then also, this is key as well. I want to look for long-term investing opportunities in quality assets that were dumped when the correlations of everything went to 1. There's a lot of these growth names that they're down 80-90%. So I definitely think there's assets out there right now that could easily double or triple or quadruple if you buy them now and you hold on to them for a few short years. So definitely a lot of opportunities out there. That about does it for this weekend market analysis video. Hope you all enjoy the rest of your weekend. As always, I'll see you all in Discord.